Welcome back. You're with us here on Editor's Roundtable. Let's talk about China, right? I mean, the big engine of global growth for the last 20 years or so. Now, perhaps, things are starting to falter a little bit there, and I'll explain why. The title is, Can China Avoid Japanification? Now, I'll explain what I mean by Japanification. I don't mean the Japan of today, but I mean the Japan of, the last 3 decades or so. The reason we're kind of picking up on this is because this week we got the Chinese both CPI numbers and producer price index numbers, and both confirm that the Chinese economy is now in a bit of a deflationary zone. Actually, it's outright deflation in China, right? And hence, people are once again asking the question. It's not a new question, it's an old question. People are asking the question whether China and the Chinese economy is going down, what we saw in Japan during the 90s, and then, of course, the 2000s as well. But let me just explain what happened in Japan. When we say Japanification, what do we really mean? So quickly, in the late 1980s, Japan saw a gigantic asset bubble, right? If you remember, there were stories which said that the imperial palace in Japan was worth more than all the land in California. I mean, it's a true story. The stock market, the Nikkei 225, went up 4 times between 1985 and 1989. In 5-year period, the index went up 4 times. What was this bubble based on? It was centered on commercial property and equity markets. Commercial property was a really hot thing, as I just explained. It was driven by highly accommodative monetary policy. It was also, and the corporate sector overborrowed, it overinvested, and overhired as well. But as it always happens, bubbles burst. It's inevitable. So the bubble burst in 1990s, and it basically damaged banks. I mean, they're the ones which get hurt the first. As a result of that, corporates cut back capacity, they cut back hiring, they laid off jobs, and of course, they cut back on debt as well. As a result of which, consumer spending was hurt extremely badly. And then Japan basically, in the late 90s, all the way into early 2000s, saw moderate deflation. Prices were not rising, prices were falling. Consumer inflation expectations also dropped quite meaningfully, which is that households did not expect increase in salaries. They do not expect increase in prices they paid for goods and services. By the way, we are still in that position in Japan, where the Bank of Japan, even now, 30 years later, is trying to get inflation back in Japan back above 2% on a consistent basis. Actually, they've got it above 2%. The aim now is to keep it above 2%. Now, what are the similarities, right? Why are we saying China and Japan, Japanification? The similarities are here. So first is the housing market, which has been the problem area for China, as we all know. Once in a while, we hear of these big Chinese property companies going bust. The correction did not start now. It's been on for a few years, but it's arguably structural. It's not just a cyclical kind of slowdown in the Chinese property market. Japan, of course, saw the biggest crash in the property market there. Corporate debt is the other one, if you can move on. For the total non-financial credit to GDP got to almost 300% of in China by the end of 2022. Back in the 90s, the number was similar for Japan as well. Similar numbers for household debt, both for China now and Japan back in 1989, which was the peak. Population is the other one, right? The share of population of people above 65 years in China and Japan, you can see the numbers for yourself, China now and Japan back then. External front, and this is important and interesting. Just like what we saw, what we're seeing in China, which is China enjoying a huge trade surplus with the US, and that raising concerns and tensions. Japan had the same problem, and that basically led to US trying to hit back, striking back in terms of tariffs, in terms of asking for more open access to markets in Japan back then. All of that, it's a repeat. We are seeing what we saw back in the 80s, but what we're seeing in China now. Challenge to the US, right? Rise of Japan and China now is a challenge to US as the largest economy in the world. And as I said, the US is fighting back now. It fought back then as well. And this is the reason why many fear that the single largest sort of incremental contributor to global growth, which is China, perhaps may go into a bit of a funk, may go into a bit of a prolonged down phase, which is what we call Japanification. But it's not all similar. It's a big subject, right? I'll just leave you with a little bit on the optimistic side, how China differs in a more positive way as compared to Japan of the 80s and 90s. First is, I mean, China's got much lower urbanization, which means, there is a greater room for people to move from rural to urban areas, which means larger potential for productivity increase. It's got a huge domestic market, is a technological leader. EVs, for example, China leads the world. China's capital account is not fully liberalized, right? Which means that there can't be a fire sale of distressed properties and other assets in favor of assets abroad. And of course, the political system is very different. China can do things which other countries can't do simply because of the political system it kind of enjoys. But it's a topic which I suspect we will keep coming back to over the next many years as this plays out. Let's just let me put this to Andrew, if he has any thoughts on this one, because if this were to play out the way many people expect, I think it'll have implications for for many, many things. Andrew, briefly, your comments.
So a few things, Prashant. A great analysis, by the way, because I remember Japan falling very sharply as well back in those days. But I think a couple of things slightly different here. I think the deflation is probably more temporary over the next few months. I think you'll see that some of that is more to do with year-over-year comparisons. So I think that the inflation will start to pick up. I think secondly, I think the biggest factor is obviously, whilst you talked about that aging population, let's not forget that there's 430 odd million people under the age of 30. So it's going to be a consumer-led market. And of course, industries across the world will still want to go to Japan. There might be just some, with the US, that kind of geopolitical kind of nervousness, and that's why India is seen as +1. But overall, I feel that it's a big enough economy to get through this, and I think you'll see that the government will make some of the right steps going forward. So I'm not as negative as the comparisons are good, but I don't think I think if anyone looks at what happened in Japan, then the steps that they need to take will be taken very swiftly.
Okay, well, Andrew, we'll let you go on that note. Have a great weekend. Thanks a lot for joining in. And to all of our viewers, have a great weekend. The news continues right here on CNBC TV18. So Dalal Street sees red for the third straight week. For the first time in 5 months, the sensex and the nifty fall over 0.5%. Mid-caps bucked the trend. That index ended with gains. Hello and welcome to another episode of the Editors Roundtable. I'm Sonia, and with me the boys Nigel, Nimesh and Prashant. We're missing Anuj this week, but so much happened this week, right? Big block deals on Dalal Street. Platform companies came back in a big way. The new kids have not really performed that well, and the spotlight on new age tech companies as well. So, how was your week?
I mean, went well, right? And you said that we were down for the third straight week. It doesn't feel like it. If this is the correction we're going to have, I think, this is okay, right?
Yeah.
I mean, it's slow.
The bulls will be okay with it.
It's slow burn. I mean, there's no sharp drop-off or fall which is happening. Although I was checking the week-on-week change, mid-caps and small-caps, by the way, ended the week higher.
Yeah.
Bank Nifty is the one which is the problem. I mean, both those, the Bank Nifty is down 1.5%. The Nifty is down manageable 0.75% or so.
Prashant, we're not used to this kind of weekly, negative closes. It's a third straight in a week that we're ending negative. Since March, it's not happened. Every week on a week, we've been trading higher or closing higher. So third consecutive week of negative close is something which a lot of traders are getting worried.
But that's what I'm saying. We're still at 19,400, 19,500, right?
So it's been largely range bound, I guess.
It's like you're going for a drive, you're enjoying the drive, but the accelerator is not working too well. The Nifty Bank, that's the only one that can take us higher.
Yeah.
And that's not functioning too well. So now you're in that clutch, axie kind of mode. So
I thought you were going to say...
All right.
Vroom.
Actually, I took this off from Anuj. Anuj was talking about 4 tires of a car, and one of them was. So I said, let's put it into into another way.
Okay, but by the way, there's a long weekend coming up, so all that drives and those rides and everything can be done right during the long weekend. But we have Andrew Holland, who's also joining us on the Editors Roundtable this week. He's the CEO of Avendus Capital. Andrew, welcome to the show. How are you feeling about the Indian market now? I mean, largely it's been so range bound. It's like just taking a bit of a breather after a long marathon, right, that this market has run. How are you looking at it from here on?
I'm actually feeling a little bit more concerned in the very short term. I mean, we had that great run and the market was looking anyway overbought. But, you know, I was listening to the RBI governor yesterday, and there's a few things that came out. One, you know, he sounded quite dovish, not dovish, but a little less hawkish than we were expecting at the beginning. But his actions were more hawkish in terms of increasing the inflation rate expectations, and obviously this extra kind of CRR hike for the banks. It says it's for the short term, but it just takes the edge off the markets, I think, and particularly the banking index, where anyway we were thinking that, you know, banks have to kind of compete very heavily for deposits. So, you know, that taking that liquidity away, talking about higher inflation, talking about El Nino, just takes the kind of edge off our markets from a regional context as well. So I think we could grind down a little bit more from here, maybe towards that 19,000 level on Nifty.
Okay, well, you know what? We have many questions for you, but let's get straight to a couple of the big things that happened this week, right? Nigel, this year, or rather in the last 1 year, there have been some big bang debuts that have happened on Dalal Street. But 1 year down the line, it doesn't feel like big bang anymore.
Well, you know, Sonia, we know each other for many years, right? And some of us became parents when we were in CNBC-TV18. And the one thing that worries us always is, are the kids all right? Right, when we come to work. So just putting that into the stock market balance, you know, the street is getting a little bit worried. Are the kids all right? You know, that's the worry, because some of these new age companies, new companies that came on, the IPOs, well, they had plenty of promise. They have plenty of concepts as well. And there's plenty of potential as well in there. But the worry is, are these new kids all right? And I'll tell you why. Because in the past quarter, you know, some of them, they have seen a compression in terms of margins. You have EMS companies like Sirma as well as Avalon. The story is very, very good. But the compression in the margins is a bit of an issue. You have IdeaForge as well, which is a very good story, the drone story out there. But there's a compression in margins, and Dreamfolks as well, which basically deals with the service costs that take rate out there. Out there as well, we saw some bit of compression in margins. Even a couple of other names, new companies that did get listed, like Keynes and Ikeo Lighting. Well, on a year-on-year basis, in fact, the margins, they're not much of an issue. The problem is that the Q4 of the last fiscal was very good. And from there, there's been a little bit of a come-off in terms of margins. So that's been a bit of an issue. Short point is, for the first quarter, the street has got a little bit nervous with regard to their performance. Now, let's run you through the oversubscription. Some of these companies got oversubscribed big time, barring Avalon. Otherwise, just take a look at the subscription out there. But from the highs, they've corrected quite a bit. You know, some of them, barring a Sirma that's down only around 5%, as well as a Keynes that's down around 7%. Some of them have seen a correction of close to around 15 to around 25% odd. Moving to the next point then. Well, at highs, some of them valuation-wise were very, very expensive. But since we have seen a bit of a pullback in terms of the stock price, well, they're not cheap, but they have good concepts and good potential as well going ahead. So valuation-wise, they've become a little bit more cheaper in comparison to what they were at the top. Finally, what do you track from year on? Well, the order books, that's very, very important, since bulk of them were EMS companies. So the order book needs to swell up. Then you focus on execution and margin performance from year on. Some of these managements have joined us here on CNBC-TV18, and they said the past quarter is a one-off, things will improve from year on. And finally, the competitive intensity is likely to pick up in the EMS space. So can they all prosper? Well, that's something that time will tell. For the time being, though, the street got a little bit worried with these new IPOs. Are the kids all right? That seems to be the question. Well, let's get in Andrew Holland's view as well. Andrew, some of these new themes, I don't know whether you've participated in them, but some of these IPOs, they have plenty of potential. The drone maker, the EMS companies. What's your view on them? Some of them have come off from the top. Would you look to get in?
Yeah, I mean, they all did well initially, right? And so therefore, when markets kind of come off a little bit, you're going to see some profit taking. But, you know, the electronics industry, for example, is something that I'm very bullish on. We're just at the very, very start of this whole kind of runway for these companies. So, you know, you're bound to see a little bit of profit taking, you know, from investors as markets kind of come off. And that's fine. But I think if you look over 3 to 5 years, the growth, not just domestically, but the potential for exports is just enormous. So, you know, I'd be looking to add these companies on these kind of pullbacks in the share price, because, yeah, there might be a little bit of margin compression now, but, you know, in 3 to 5 years' time, it wouldn't have mattered because of the whole growth story that you're going to see from the electronics industry. So I remain bullish on this sector.
Okay, remain bullish on the sector. Well, let's also talk about what happened in the dealing rooms this week, right? Because largely, Nimesh, I think it was range-bound week. Not too much happened. There was a little bit of a downside, but some block deals were in focus.
Some block deals were reported, but largely on the markets first. While you were right in saying that it was only range-bound, just 200 points on the Nifty. But as I said, third consecutive weekly close. Now, whether it is just a one-off or it's a trend reversal, that is something which a lot of traders will be worried about. So I think that needs to be seen how next week pans out. We have a truncated week as well. The FI has also turned negative, in terms of cash market buying. So even that's a bit of a worrying sign that the flow which was pushing the markets higher, that seems to be ebbing a little bit. So that's something to watch out for. I guess you rightly pointed out there were large blocks, by promoters and PE sold. I'll talk about it a little later. But again, quarter one was a bit of an eye opener as well for a lot of stocks. As you pointed out about the new age companies. If you look at the stocks there, a lot of stocks were part of the EMS space, right? Yeah. And I highlighted this, that while the story looks good, be aware of the narratives, because the valuations was like too high. Everything was quoting above 50, 60 times, right? For companies whose margins are not going to be even in double digits. Yeah. We saw this happening in quarter one. So that was a warning sign that there is a bit of narrative now in a lot of the mid cap and small cap. That's something which one need to be careful about. So I guess that's played out in quarter one earnings. So it was a bit of a reality check as well. But for me, whether it's a trend reversal, that's something to track. And the fact that there was another $1 billion of selling from promoters and insiders, that was a big takeaway for me from dealing with this week.
Okay, another thing that we wanted to talk about this week was a bit of a turnaround that we saw in the numbers for some of these platform companies, right? So it started off with, of course, Zomato reporting their profits for the first time ever. You want to debate that, you want to go, go through the fine print, fine. But at the end of the day, they did report a profit. PB Fintech, the losses narrowed year on year. Paytm has now been operationally profitable for 3 consecutive quarters, and Delivery as well. Their net loss last year was almost 160 crores. This time it's narrowed down to just about 9 crores. So definitely we're seeing an improvement in the operational performance of these platform companies. Now, what went right? A couple of these companies, right, whether it's PB Fintech, where you've seen the core online business for them improving, the revenues went up 40% in Q1. The EBITDA consistently has been growing at over 50 crores year on year on a quarterly basis. Paytm has now given a guidance of being free cash flow positive before the end of the year. Delivery, the volumes and revenue in the express parcel business surprised positively. And Zomato was, of course, well documented. The food delivery gross order value went up 11% quarter on quarter. And there was a steady improvement that we saw in the contribution margins as well. Quickly, I wanted to just put forward the brokerage views. Goldman Sachs raised their target price on Paytm to 1,200, maintained a buy. They said that Paytm is firmly on track to become the most profitable India internet company by the end of FY25. So that's the conviction they have in Paytm. Citi has raised their target price on Zomato to 115, saying that it was a stellar show, solid margins, sanguine growth. Morgan Stanley has an overweight on Delivery and saying that the EBITDA was better than consensus estimates. But I do want to ask, Andrew about this, because Andrew, although the platform companies have, seen a goodish amount of move, a lot of the run is already done the price, right? I mean, I was just having a discussion with Motilal Oswal's Gautam Dugard, and they got into Zomato at 50 rupees and now it's almost doubled. So do you think it's too late in the game to sort of get into these companies?
No, I don't think it's too late at all. I mean, I think everyone should be thankful that they're getting to profitability, cash flow, or generating cash. And I think that was one of the things that everyone was worried about. I think with Paytm, maybe it's the narrative when they first came to the market, which they've now focused that in terms of what they're really doing, and I think that's paid off for them. And in terms of the share prices moving before they moved to where they are today. So I think all of them will continue to do well. My only kind of short-term kind of reservation, if it is that there's some big players coming into some of these into some of these areas, and that might kind of put some pressure on going ahead. But that's a little way out. But it's just a reservation I have in terms of the share price moving up significantly from here. But I think you'll see some 10 to 15% moves for some of these companies over the next 6 to 9 months.
Sonia, I was in Bangalore last 2 days, and I met a few founders, and they all actually were talking about what do you think of what is happening to listed companies in their, these names, Paytm, Zomato, because some of them are thinking of making it to the markets and saying, I think the
Should
markets...
Should I not?
I mean, it was completely a no-no till last year, but I think now mood is changing.
Yeah.
No one
They're
really
seeing-
believes the pace at which they are achieving profitability, right? So fast.
I mean, I don't know, but they're happy that they are, right?
Yeah.
I mean, for example, Zomato, as you said, got to with profitability 1 year before guidance.
Yeah.
So, I mean, it's a happy kind of outcome, and it's encouraging for these unlisted players who at some point will
And
be
for
listed.
the startup world as well.
Yeah, the other one is Zomato, which you guys were talking about. This ONDC, right? Nimesh and I were talking about before we came onto the show, which is Open Network for Digital Commerce. It basically brings together all platforms.
All the platforms.
So the big debate has been whether it will be a big disruptor for the food category in the listed universe. Swiggy, Zomato. There is no clear answer, but the people who are building ONDC are very bullish. They're saying, well, nobody believed Aadhaar and UPI. This is linear, and then it'll
be investors
exponential.
as well. Prashant, when I talk to large investors, they talk about ONDC as a big concern for food delivery businesses. So I guess that's well documented that that's a bit of a risk for something like Zomato.
Okay, I definitely have a addiction to these food delivery apps, especially when you have small kids at home. All these Instamart and everything. But Nimesh, tell us about the big block deals this week. What happened there?
Well, Sonia, last week I spoke about large blocks, and we thought that was big. This week was even bigger. Already $1 billion block was done this week itself. And if you just look at the list of names, like CMS Info, 21% of the company's equity got sold in a single day. Bearings Private Equity sold a large chunk. This is the second tranche that they've sold in less than 3 months, and they raised close to 1,000 crores. The second big name was Adani Green. The promoter entity sold 3% equity to Qatar Investment Authority, and they've raised close to 4,100 crores in that block deal. Inox Wind, the promoter sold equity worth 300 crores. There was Shivalik Biometal, promoter sold stake worth 300 crores. Minta Corp, another interesting name where PIH Capital sold its entire 5%. It was a clean out trade. They raised close to 330 crores. 361, which is ex-IFL Wealth. Even there was a large deal. Private equity investor sold stake worth 200 crores. Bikaji Foods, again, Lighthouse, which is a private equity, they sold stake worth 180 crores. And Radiant Cash was today's block where there was a 5% equity changing hands. Looks to me like private equity was a seller in that block as well. So if you look at two cash management companies, which is CMS Info and Radiant Cash, in both the companies, private equity sold big time. So 21% in CMS Info, and now today in Radiant Cash 5%. So big blocks, over $1 billion done. But if this week was big, I guess next week could be even bigger, because that's the pipeline which people are talking about, that there could be large blocks as well coming next week as well.
For some of these companies, it's interesting, right? Because as the performance improves, shareholders get very happy, like, wow, things are turning around. And suddenly you'll see the big investor coming in there and saying, okay, I'm cashing out.
So then what do you do?
I spoke to a lot of investors, buy sides, PE guys who are selling and who are buying as well, right? It's a very mixed view. A lot of people ask me whether this is a sign of a peak out. I don't think that's a real answer. That's a straight answer to it. There are a lot of compulsions for PE guys. There are a lot of opportunities for funds and look at CMS Info, 21%, all bid by the best of the blue chip, FI investors. So, it's a very mixed feedback on how to read this block data and whether these are signs of peaking out. But everybody's got its own compulsion to buy and to sell as well.
Okay, well, let's do one thing. Let's take a short commercial break on that note, but lots more coming up on the other side, so don't go anywhere.